It's the special edition of Business Incorporated. Thank you for joining us. I'm Chimeze Obi Iwagu. The Monetary Policy Committee of the Central Bank of Nigeria is set to announce its decision for the fourth MPC meeting in the year 2020 amid fears of escalating tensions arising from the spread of COVID-19. And in line with the global trend where several systemic central banks have been announcing various stimulus packages to whittle down the debilitating effect of the virus, the CBN also had announced some stimulus packages since the start of the pandemic to support vulnerable sectors and stabilize the various macroeconomic frailties that are crystallizing off the back of the COVID-19 pandemic. Well, central banks across the continent have adopted aggressive monetary policy initiatives in an attempt to boost liquidity in their economies, massively increasing the funds available to commercial banks and introducing debt repayment holidays. Well, here are some of the approaches central bankers in sub-Saharan African economies had taken. Let's look at South Africa. The South African Reserve Bank slashed its repo rate by 50 basis points to 3.75% during its May meeting, a level not seen since the 70s. The move follows a 100 basis points rate cut in its April emergency meeting. The Reserve Bank Monetary Policy Committee is scheduled to meet this week, July 21 to 23, and economists project a further 25 basis points easing this time. Here is what Ghana did. Ghana became the first sub-Saharan African country to cut interest rates in March in response to the coronavirus pandemic, reducing its benchmark to an 8-year low. The monetary policy rate was reduced to 14.50% from 16%, the first cut since January 2019. Then at its MPC meeting held in May, Ghana's central bank left its rate steady at 14.50% but purchased the government's COVID-19 relief bond with a face value of 5.5 million cedi at the monetary policy rate with 10-year tenure and a 2-year moratorium of principal and interest. Ghana's Monetary Policy Committee is set to meet this week, July 22 to 24. Now, in Kenya, the central bank kept its benchmark interest rates unchanged at 7% during its June 2020 meeting. Policymakers considered that the package of policy measures adopted since March to cushion the hit from the pandemic were having the intended effect. At its March meeting, the Central Bank of Kenya lowered its benchmark interest rate by 100 basis points to 7.25%, surprising markets that expected a smaller 25 basis points cut. In April, the bank held a special meeting of the Monetary Policy Committee where it cut further its benchmark interest rate for the 4th time in a row to 7% from 7.25%. However, at its May meeting, the bank left the rate unchanged at 7%. Kenya's Monetary Policy Committee is scheduled to meet on July 29. And, of course, here is what this oil exporting country, Angola, did. The National Bank of Angola kept its benchmark interest rate unchanged at 15.5% during its May 2020 meeting amid the continued depreciation of the kwanza and the galloping inflation. Policymakers said the current policy stance remains appropriate to support its inflation commitment given the worsening economic conditions. Angola's interest rate has remained steady at 15.5% since November 2019. Now, the Monetary Policy Committee is scheduled to meet this week, July 24. Okay, in about half an hour from now, the Central Bank Governor Godwin Emefiele will be announcing the key decisions at its meeting today. But then, what are these key macroeconomic indicators the MPC will have to consider as it makes its decisions, and what are the monetary policy responses so far? Temple Ashaju will give us those details. Temple.
Yes, Chibeze, thank you so I mean, we know that this is the current look of the monetary policy parameters so far. The last meeting, which held on May 27, 28, we had the MPR settling at 12.5%. It was actually reduced all the way from 13.5% to 12.5%, and that represents a 100 basis points decline, which the members of the committee voted for. Asymmetric corridor remained unchanged, 200 plus 200 to minus 500 basis points, and of course, CRR remained at 27.4%. This was the level that we saw it settled at in January when the committee first met earlier this year. And of course, lending rate was at 30%, considering all of the decisions that they have taken. Look at the exchange rate adjustments that we've seen since this year so far, first half of the year. We know that sometimes in March, we got the 305 naira to 360 naira adjustment in a bid to harmonize the whole multiple windows of exchange rate that we have in the country. Then again, we had another FX adjustment all the way from 360 naira to 380 naira. This was earlier this month, July. And of course, this is something that the CBN, led by Dr. Godwin Emefiele, is hoping will be able to harmonize or unify the rates in the market going forward. In terms of other regulatory actions that we've seen, the cash reserve ratio debit has been 4 times this year. Since January till date, we've seen 4 cash reserve ratio debits across banks, when a bank that is supposed to have to maintain a threshold of 27.5% exceeds that. The CBN debits that, especially at their participation at the open market operations window, and of course the various auctions that we have in the market. Then there has also been 2 key statutory debits across the banking sector so far this year. We had that of NDIC, which is a statutory debit, and we recently had that of AMCON across the banking industry. In terms of other activities, we've seen introduction of the GSI, which represents the Global Standing Instruction. That came in last week, and of course, we've gotten the non-interest guidelines for a couple of other intervention programs by the central bank. That's the Agriculture, Small and Medium Enterprises program. That's something that is supposed to help increase liquidity in the system. Moving on, we've got of course, you know, of the stimulus measures that we had before now, the 1-year moratorium principal repayments, especially for loans taken from government, and of course, the interest rate reduction and intervention loans all the way from 9% now to 5%. That's something that some folks have been taking advantage of lately, that we have the strengthening of the loan-to-deposit ratio, which is currently at 65%, even though we know that that is currently being challenged by the COVID-19 pandemic. And of course, we've got the 50 billion naira target credit facility, which a lot of companies have possibly benefited from. Then you got the regulatory forbearance to banks in terms of loan restructuring for a lot of the corporates. Then you have FX supplies to CBN all the way from oil companies via the NNPC, because before now it goes through the NNPC, but now oil companies and of course offshore players now channel these FX directly to the CBN to be able to cushion the effects of the COVID-19 on the FX reserves. Then you have 100 billion naira additional fund put together for healthcare, pharmaceutical companies, and a couple of others. Look at the fiscal measures we've seen lately. We've seen the revision of the budget. We saw a revision by about 301 billion naira. And of course, we know that there are several assumptions in that budget. And of course, we've also seen last week the passage of the MTEF for 2021 to 2023. These are major indicators that investors are watching. And of course, we do hope that the CBN Monetary Policy Committee today will look at critically and be able to arrive at their decision for today. And of course, I should end by saying that the new electricity tariff that was meant to take effect in April and of course shifted to August now has been postponed to the first quarter of next year, January to March 2021. Chimizi.
Right, Temple. And to dissect some of these issues and set the tone for the announcement of the MPC decisions today, I have with me in the studio the Director General of the Lagos Chamber of Commerce and Industry, Dr. Muda Yusuf, and of course the CEO, CFG Advisory, Mr. Tilewa Adebajo, joins us via Skype. And in our Abuja studio, I have Professor Uche Waleke, Professor of Capital Markets at the Nasarawa State University. Thank you very much, gentlemen, for joining us on the show.
Thank you very much.
All right, now let's start this conversation from the FX market. And Mr. Adebajo, let me start with you. You are one of the people that has always advocated a unified exchange rate. Just a few weeks ago, the central bank made the move by adjusting the official rate from 360 to the dollar to 381, bringing it closer to the rate at the INE window. Was that in line with your expectations?
Well, I think the approach is gradual and I think it's phased. And I think there's a step in the right direction, but we're not yet there. And I think this is very important because not only do you send the right signal to the markets, but you understand that the diaspora money that comes in at about $25 to $30 billion a year is higher than the foreign direct investment that we have in this country, or even the foreign portfolio investment that comes into this country. Last year, the central bank has been using the OMO bills to attract the foreign portfolio investors, and it leads to a high cost of borrowing, which clearly is not sustainable because the rates we're paying are too high. Also, as you know, we already applied for an IMF loan and also a World Bank loan. And one of the conditions of those loans is that before we draw down on those facilities, we have to have a unified exchange rate. So I think all these pressures, I think, is what is pushing the government and, of course, the central bank to begin to have a unified exchange rate system. It's happening slowly but surely, but we're not yet there. So we're waiting until we get there, but definitely the step in the right direction. And I think a unified exchange rate system will be beneficial for everybody across all sectors of the Nigerian economy.
All right, Professor Waleke, let me come to you. For an ordinary Nigerian, like me, when they hear that the naira is being depreciated or devalued because there is this fear it's going to bring about high inflation, or probably dollar is going to go up or become more expensive. For you, from the investment point of view, what do you make of that move by the CBN?
Thank you very much, Chimeze. There is no doubt at all in my mind that the devaluation of the naira that is coming from the CBN, or a depreciation of the naira as a result of market forces, will have near-term consequences with respect to inflation. There's no doubt about that, given the fact that this is an import-dependent economy. So the moment you devalue, and what happens is that imports become, more expensive, and that has a pass-through, to general price level. So that is not in doubt. But again, we also have to look at the upsides. One of the upsides, if you like, is also, an attempt to increase the what's available, by way of what is shared between the federal and the subnational national government. So when we unify and exchange rate, for example, moves from the official 360 to 3, maybe align with the INE window, and oil proceeds is now done at 385. Of course, we are going to have an increase in what is shared beyond what we have now. Of course, as you know, only last month the FAC shared for last month the FAC shared 600 billion naira. So if we unify, you're most likely to have something higher. That is one.
All right,
The other thing
Professor Waleke, Professor Waleke, I'm sorry, you just have to hold your thoughts there. Let's take a quick break. When we come back, we'll continue with this conversation. Just stay with us. Welcome back. You're still watching Business Incorporated Special Edition, and I still have with me Dr. Muda Yusuf, the Director General, Lagos Chamber of Commerce and Industry, Mr. Tilewa Adebajo, CEO, CFG Advisory, and Professor Waleke, a Professor of Capital Markets. Well, Professor Waleke, yes, you were talking to us about what this whole thing at the foreign exchange market means for an investor and investment, and you were trying to make some points. But please, could you kindly make it briefly? Thank you.
Yes, to the point, transparency. It fosters transparency in the market, and of course boosts confidence. And once you have transparency, in the market, of course that will encourage investment, whether on the part of domestic investors, particularly foreign investors, because it brings clarity, to the market, to the extent again that it discourages round tripping and all manner of sharp practices. So I think it's positive for investment flows into Nigeria.
Dr. Yusuf, Now, you are speaking from a business point of view. For a businessman, what does this mean? There seemed to be a whole lot of confusion in the exchange rate market. Some analysts have argued that the central bank is yet to, really make up its mind what it really wants to do with the exchange rate. On one hand, it wants to unify the rates and encourage, local production. On the other hand, it looks as if it still wants to keep holding back and keep defending the naira. For instance, the recent announcement about banning maize importation. For some analysts, they believe, look, if you want to do this, if you truly want to unify the exchange rate and, encourage these people to look back, you really don't have to go that way. Just do the right thing, and then every other thing would come in place.
Yes. One of the major challenges that businesses are facing right now is the crisis of liquidity in the foreign exchange market.
Absolutely.
And it's a very profound issue because the implications are quite enormous. It has a whole lot of implications for confidence of domestic investors. Because as I speak to you, many of them have lost their credit lines because they were not able to remit to service existing outstanding obligations to their creditors. So that means now for practically all transactions that you are going to get for LC, you have to provide the cash. That will further exacerbate the pressure on demand. Then we have a huge backlog of demand for forex. Some of them are investors, some of them are portfolio investors, some of them are foreign direct investors and all of that. And there is nothing that undermines an economy as when you have a situation where you have a collapse of confidence, when there is so much uncertainty. So I think as a matter of urgency, we need to fix this issue of liquidity in the foreign exchange market. This is not about the rate. It's about creating liquidity and creating certainty around the market. Let us have a clear framework as to how this market is going to be managed, irrespective of what the rate is. If you know the rate, at least you can plan. You can factor the rate into your business model. You know whether it will work for you, whether it doesn't work for you. But when you have a situation where you are completely in the dark, some people make requests for FX, they get 10% of their demand, some get 20% of their demand. The economy cannot run that way. So we need to urgently bring clarity to the foreign exchange market. If you want to fully float it or manage float or whatever you want to do, let us do.
But there has to be some kind of clarity.
There has to be clarity. We now have a lot of shift now into the parallel market. And look at the widening of premium. Parallel market rate now is 470.
Yeah.
And it's still rising.
Now, interestingly, the Bureau de Change operators have actually not been in business yet. We're seeing this speculative buying. Just one would wonder, okay, so what happens by the time the BDCs come back to business? Mr. Adebajo, I take that to you. What do you think would happen by the time the BDCs come back to market, having listened to what Dr. Muda has to say?
Okay, I think I agree with what Dr. Muda is saying. And I think more importantly, apart from the transparency, is the mechanism. The problem we have is the Bureau de Change operators are not major players in the markets, with all due respects. They help to stabilize the market here and there, but they're not the key operators in the market. It's the banks. So what is important is that not only should you have a transparent system, but you mustn't have a static exchange rate mechanism. You need to have a market-driven exchange rate system, whereby, for instance, now we know that oil prices are down and maybe they're not as robust, the reserves are not as robust as they should be. So we understand that at that point in time, the price might be higher, as he has said. So once that price is higher, you're able to meet the demand. You make that price according to demand and supply. But you see, what the central bank has failed to do over the years is that when the oil prices improve and when our reserves improve, they fail to depreciate the naira. So basically, you can appreciate it and you can depreciate it. So once everything is better, then what you need to do is that you need to appreciate and depreciate the currency according to demand and supply. But what we tend to do is to leave it in one just fixed static mechanism. So not only do we need the transparency and accountability, but we need a market-driven rate system that can get the market to adjust and according to supply and demand, appreciate it and then depreciate it at the appropriate time. That is really what the market-driven mechanism would be. Yes, it will be good when these bureau de change operators come back. It will be able to maybe stem speculation a bit and stabilize rates. Yes, they do have that effect on the market in the sense that it becomes a speculative issue. But what is important is the mechanism, bring back the bureau de change, but the question is the demand. Can the central bank meet the current demand of foreign exchange in the markets? And at what price? And that's the question we need to answer. Once we answer that question, then put in a market-driven system, everybody will be happy.
Perhaps the central bank governor will probably answer that question by the time he briefs us on the decisions taken today. All right, that's where we wrap up the show. I've had Dr. Muda Yusuf, the Director General of Lagos Chamber of Commerce and Industry, Mr. Tilewa Adebajo, CEO, CFG Advisory, and Professor Waleke, a Professor of Capital Market. Of course, we will still continue this conversation just pretty soon. But for now, that's where we end Business Incorporated Special. Thank you for watching. I'm Chimeze Obi Iwago.